Hey everybody, thanks so much for joining me. This is Kyle Stringham. I'm with Canopy Mortgage. I work in Utah, Idaho, and Wyoming. Now, this video, this is going to be a slide share really, and this is going to be a bit of an education class on right-sizing retirement with a reverse mortgage for purchase. Yes, you heard it right. This is using a reverse mortgage to purchase your next home. And this is meant for those that are 60 years of age. Maybe you're, in your late 50s, and this might be a solution you're thinking of, or you're a real estate agent and you really want to offer your clients some options that truly serve their needs and will help them to have that quality of life and really, provide that impactful service you're looking for. Okay, guys, well, let's jump in here and I'll get going on a reverse mortgage for purchase. Now, really quick, reverse mortgages for purchase. I'm going to run through these boxes, but these were established in 2008, and it's through the Housing and Economic Recovery Act, or HERA, as we like to call it. Now, this allows borrowers to make an initial equity investment or a down payment, if you will, in the home. And this is using the HECM, or Home Equity Conversion Mortgage, proceeds to make up the difference. Okay. Now, for homeowners, this is really something that has complete home ownership in the property. As I said, or maybe mentioned, reverse mortgages, they got kind of a bad rap early in 2008. And it's really because they weren't structured properly, to be honest. The oversight and a lot of the compliance now that is required makes them so much better. These are non-recourse loans, meaning they're not going to come in and take your house, right? These are done in a very specific way that allows you to keep a specific amount of equity in your home. And you basically, to just get to it, you would roll over your proceeds from your home that you sold, and I'll provide some examples inside of this, and really put that as a down payment on your new property. And that mortgage is going to, in effect, reverse itself, and it's going to pay itself down. So it's pretty exciting. Now, this follows the standard for the HECM loan terms. Again, Home Equity Conversion Mortgage. You're going to hear that term a lot. And these are typically FHA loans. And these are done a special way. No monthly mortgage payments, non-recourse loans. Full repayment is not required until the last surviving borrower or spouse leaves the property, okay? And then borrowers are responsible for, and this is important because doing this loan doesn't mean that you don't have any payments. It really means that you're going to still have to pay. If there is a homeowners association, you'll have to pay your homeowners association dues. You're going to pay your taxes, your home insurance, and you've got to keep the home in good repair. Of course, all of us, homes are a very large investment, and we want to make sure that they're in the best shape possible. So I'm sure that is not a problem. So we're going to get into HECM for purchase. Now, here's some benefits that I would like to call out. Now, I'm going to see if I can't move me. Looks like I can't move me, but this is going to increase your purchasing power. Okay, it really does. It allows you to purchase a home and it'll increase that power, and we'll show examples. Now, this preserves your cash reserve. Okay, this preserves cash in the home and it protects it. Now, it provides flexibility for repayments that can be optional. So you can actually get a type of reverse mortgage that allows you to make payments if you want to. Okay, and then this is a single purchase transaction, one and done. The ability to access a portion of your equity investment. So you can actually have part of your equity available. Say you had an expense coming up and, wow, we want to do something special. We need to access $75,000. You can access that inside of your loan for it to be, structured properly. And that money that is sitting in your home, guess what? You have a guaranteed investment return that a lot of people don't know about. And this phenomenally, it beats out, most normal investment plans, and it guarantees an 8% return yearly on the funds that you haven't used inside of your HECM. So if say you start making payments and those sat there for a year and it was $200,000, you made 8% on those funds. That's 16K. So this is just an example, but also equity realignment. And this is a new way to use your equity. So FHA, as you heard me say, HECM fixed, or your home goes in. This is a fixed loan where it can just go ahead and actually reverse those payments, or it can actually have a line of credit. Now, the maximum recognized home value, okay? So even if your home in this example was worth $2 million, FHA is only going to recognize a home value in 2024 of $1,089,300. Now, the minimum age for you to take on one of these types of loans is 62 years of age or older. And you can start them as low as 60. There are some things that we can discuss that it changes your terms a bit. There's no minimum credit score. Okay, so say you come in, you've got a credit score to 620. Hey, there's things we can do to help out. Now, MIP, mortgage insurance premium, it is included in the cost. So this is the upfront mortgage insurance premium provided by FHA. You pay that, you're good to go. The line of credit can be overfunded for future use, meaning you have extra cash, you have extra capital from the sale of your home, and it doesn't all need to be used in that 65% loan to value loan you're going to get through your reverse mortgage. Well, guess what? You can actually add on more funds. Say you want to give another $100,000. Now you're overfunding that account, and that's giving you that return that I discussed of that 8%. Now, also, the line of credit can grow over time. Why does it grow over time? Because your home is appreciating. Your increased equity keeps moving forward. Think of, in the last 5 years, how much equity you have actually gotten from your home. Pretty exciting, right? Think if you had those extra funds in there and those were appreciating along with your property. Okay, so fixed rate loans, they are a single transaction. Okay, all right, so we use a company called SmartFi. Again, Kyle Stringham through Canopy Mortgage. We structure, I am your reverse mortgage expert that helps you structure the loan. I walk you through all the details. We even give you training so that you really understand how this works. These aren't super fast loans. These aren't typically loans that are done in 30 days. We want to make sure that it's the right decision for you. And everyone has a specific plan and future set out for their life. And so this is something that can really help you to make that decision. This is we don't want you to be scared to reach out and really get educated on the benefits and how this would look for you. Now, in this situation, we're going to show that we have a maximum loan amount of $4 million, okay? So that's your maximum loan amount. Minimum age of borrower, 55. Minimum credit score, 600. Now, this is very simplified, direct, sensible underwriting. It's not all over the place for you to get your approval. There's no mortgage insurance premium, and this is a traditional seller concessions are allowed. And this is called the SmartFi Choice program. And this might be, SmartFi Choice might be for someone that's entering in at an earlier age, as you can see that age of 55 and older, and it actually is going to give you access to that cash depending on what you need. Okay, so traditional purchase versus a HECM purchase. Now, agents, this is something you want to pay attention to because there's a few changes here, but it's going to apply to so many of your clients. And really, if they're of that age of about 55 and older, you do want to ask the question if they have any interest in a reverse mortgage purchase and how you can make that happen. And you would be selling their remaining home and then taking them to their new home. Now, traditional interest rates and FICO are score sensitive, right? You're only going to get certain terms with a normal purchase. HECM, no minimum FICO score, as you saw, 600, or it can go even lower, to be honest. And that's on those 62 and olders. Now, risk of foreclosure if monthly payments are missed. No monthly mortgage payments are required for a HECM loan, okay? No protection in negative equity market. Okay, so you're going to go backwards. This HECM is a non-recourse loan. Okay, so it does protect them. Now, full underwrite and debt to income caps. This one's residual income and capacity. So we just want to make sure that they have the residual income to afford their monthly bills, right, to eat and have their services, but then also to be able to pay their taxes, home insurance, and really have that quality of life, which is what these loans are meant for. There is a lot of compliance and oversight around these mortgages so that they can greatly protect your borrowers. So they are a good solution, and that's why we are trying to get the word out into the market so much more nowadays. Now, a letter of explanation is not allowed. Letters of explanation are allowed for an equivalent or a qualified event. Now, the HECM reserves are 2 to 6 months requirements, or the home reserves, the payment reserves that they require on a lot of these loans, 2 to 6 months, conventional, and then no cash reserve requirement. So no, your clients don't have to have a big cash reserve, outside of the equity they're going to receive on their property. Okay, so increasing purchase power. So here's some examples that I wanted to make sure you saw. So mortgage balance, the current home value, $500,000. The balance is $150,000, and the equity is $350,000. There's a commission of 6% for selling the home, and then the cash sale, or the cash from sale, is going to total up to $320,000. Now, new home purchase, $450,000, okay? HECM purchase, these are the two numbers. You've got your down payment, so your HECM for purchase is $181,350, and then you need to make a down payment into that of $289,320 plus the closing costs, right? Your remaining cash that's left over is $30,680. You can see the comparative analysis there. So this is overfunding your down payment where you could give more money. And so again, we have the same scenario, $500,000, mortgage balance is $0, equity, $500,000. Same amount for the commissions is 6%, cash for sale, $470,000. In a new home purchase for $450,000, we have the HECM, same numbers, $181,350. Now you're overfunding it. You're going to give an extra amount, $339,320, right? So that gives you your overfunded amount, which is going to equal up to $50,000. This gives you remaining cash from the sale of that home of $130,680. So again, if you want to not put all your money into that property and you want to have some cash set aside, you can do that. Or putting it into that line where you have funds available on your reverse mortgage can pay it that 8% a year, which is pretty beneficial. So qualifying with credit challenges, again, this is another kind of scenario, but the $500,000, you can see everything the same, equity, commission, $470. Now the new home, the HECM does increase a little bit because we call it a LISA or LESA, and that really just, it charges a bit more because of the credit challenges that we're addressing. We have to underwrite really to understand for any of the risk threshold that we're going to take on. Okay, so that total remaining cash though is $117,100. So these are still possible. Please don't dismiss these as you're looking at purchasing properties. Now, properties, single family homes, FHA approved condominiums, choice, or the SmartFi choice that I showed earlier, that is available for Fannie Mae limited review condos. Okay. Now, townhomes and planned unit developments, PUDs, 2 to 4 family homes are occupied, or that are occupied, okay? You can use these to purchase an investment property, right? Live in one of the units, you can rent out the others. Manufactured homes meeting HUD guidelines. So we know, and especially your real estate agent will be able to educate you on this, that they have to meet HUD guidelines. We call it what's called a HUD tag, meaning it's built to the specs that HUD approves it for an official home. It's built on a foundation. And it is a manufactured house. And then new construction. This is a purchase you can use for new construction on a home. You can buy your brand new home and you can actually not make payments on that. You can start a reverse mortgage. You need to have a certificate of occupancy in order to close on these. So meaning you don't use this loan for new construction until that home's completely built and done. So it is not a full construction loan, if you will. So counseling and contracts, there is counseling and education needed to get these types of loans. So this may occur prior to the written contract. You might want to get yourself educated ahead of time. Seller concessions are limited fees for a HECM loan. So reasonable and customary for the market. That means 3% max seller paid closing costs, okay? Since it's an FHA loan, the contract must include the FHA amendatory clause and real estate certification. So your typical FHA addendum gets added into your purchase agreement. And the contract should not include personal property. HECM proceeds are for the purchase of real property, okay? So these are meant to be used towards that real property. And the HECM program is used only for a primary residence transaction, okay? So this has to be their primary residence. You heard me say it can be up to 2 to 4 unit property, but they have to dwell in the property. And then the contract cannot include a real estate commission if the realtor is participating in the transaction, okay? So for real estate agents, just if you're doing this yourself, you're not allowed to do a reverse mortgage and charge commissions for your own transaction, okay? Now, appraisals and occupancy. The appraisal process is the same with HECM, purchase or refinance. We're going to do a conventional appraisal for a choice loan, but really this will be a standard FHA appraisal. 2 appraisals are needed if the loan amount is over $1 million. That'll be very rare, so many of us that won't apply. And then all repairs completed prior to close, no repair set asides, okay? So we've got to make sure that anything and everything is done to that property that those buyers wanted, and we don't have any kind of a repair escrow setup happening or something happening down the road. That is a very specific term, and the seller is not permitted to credit the buyer or reduce the purchase price for any required repairs they do not wish to complete. Okay, so again, they can't drop that price down. So you want to make sure you get that inspection, you get everything addressed early, and then must occupy the property within 60 days of purchasing. Okay, so down payment and closing. Gift funds are allowed. Well, let's start up a little bit. Okay, so starting up, evidence of cleared earnest money deposit along with 2 months bank statement sourced and seasoned. Okay, so that means that your funds are already inside of that bank account. Seasoning meaning they've been in there for at least 60 days. And we know that, the capital that you're going to use towards the purchase, except of course, if these are funds that are from the sale of your home. And then gift funds are allowed. Say your family or someone wanted to contribute funds into that transaction, totally allowed. If applicable, a final HUD-1 for the real estate sale proceeds. And then funds not allowed, seller financing, a bridge loan, personal loans, cash withdrawals on credit cards, okay? So, and then for me as a lender, I'm not allowed to give any kind of a lender credit. Again, the fees with a reverse mortgage, they're very specific. They're very dialed in. They are meant to protect you and not cause, they do this because they don't want the big boys coming in, giving some kind of a massive lender credit and then charging huge amounts of fees for them to make up with it. As we know, that happens in the mortgage industry. And all of us good lenders and real estate agents, we keep an eye out for our clients about this. So when to think about a reverse mortgage for purchase, borrowers are wanting the ability to have more purchase power. Okay, borrowers want to create cash reserves through home equity. Okay, you're wanting to make sure that you have available cash in your retirement days, or later on after 60, that you can access that cash in which is needed. Okay, borrowers wanting to maintain flexibility with home equity and optional payments on a line of credit, okay? Not having to make that mortgage payment monthly. Think of how much of those funds could be used, that you've really spent a long time pulling together all of your capital for you to be able to have a reverse mortgage, and now you get the benefit from it. And then borrowers wanting to realign their current home equity when purchasing a new home due to a life event or credit challenges. Maybe, quite often we just don't have as large retirement accounts these days. And, it's over 70% of the US is having struggles in retirement financially. And this is really a solution that can help you plan for this. Maybe you're going to have a reverse mortgage for the next 15 to 20 years, or, in some instances, you might know you're not going to be around for that long, and this is a good solution. And then the home, any assets that are left over at that time, would go to your heirs. Okay. So this creates the ability to access your home equity, have a LESA or life expectancy set aside. Okay. So that LESA allows you really your planning for that end of life event, and then for taxes and insurance, or your FICO challenges, your credit score challenges. Guys, I hope that this gave you a ton of information, and I hope that you really enjoyed getting all of this. I tried to whip through as fast as possible, but listen, again, Kyle Stringham with Canopy Mortgage. I work in Utah, Wyoming, and Idaho. Even if you're outside of those states, I can help get you to a professional that can give you the advice and financing that you need. So I welcome you to reach out. And, the biggest benefit for us as lenders of these loans is we're able to help people truly plan for this later in life housing and really plan around their finances. And again, these are loans that are done for your specific circumstance. This takes some discovery and you finding out if it's the best right for you or best fit for you. This isn't just a phone call to me or to your lender to say, hey, this is something that you'll research. We will get you a quote together. We will let you look at how the whole transaction would come together. Say you're working with your real estate agent. You would get with me and we can show, okay, here's the proceeds from your home after the sale. Here's what it would look like as applied to a reverse mortgage. We'd be happy to do that. So thank you again so much for your time. You can reach me at kylecan.com, my cell 801-991-0100, or my email. Thanks so much. Have a wonderful day. Hope to see you soon. Bye-bye.